Hello and welcome to the LSR Weekly View. So this week saw another FOMC meeting and another revision down of their so-called dot plots. Now perhaps this shouldn't come as too much of a surprise. It comes at the end of a run of weaker than expected US data, exemplified of course by that 38,000 payrolls number for May. But in the asset allocation document that we're publishing today, we still expect 2 rate increases from the Federal Reserve during 2016. And the crucial point to remember here, and why we expect this, is that the bar to rate increases and rate normalisation in terms of growth is lower now than it has been probably at any other point during the recovery. Why is this? Well, as we learnt last year, the Fed considers the trend growth rate of the US economy to be 1.8%, and they think that all spare capacity was exhausted during 2015. Consequently, you've had various Fed officials talk about a 2% growth rate as what is required for rate normalisation to continue. Now, what is a neutral rate, a neutral real rate in the US economy? Yellen has spoken on numerous occasions of it being potentially zero. Now we think that's a little bit pessimistic anyway, but even if it was zero, that would be consistent with short-term nominal rates of around 1.5%, 1.75% anyway. Now the fact that so much of the weakness that we've seen over recent months in the US economy has been in the external sector confirms our analysis that it can be mostly attributed to the dollar strength that we saw in the second half of 2014 and early 2015, when of course trade-weighted dollar strengthened by almost 25%. But that is a one-off shock, and as that dissipates, then we would expect this 2% hurdle rate to be surpassed during the second half of 2016, and consequently rate increases to come through. Now this view of 2 rate increases during 2016 has fallen in and out of favour over recent months, and I think it's definitely out of fashion at the moment. But as that unpause pattern of US growth that Greenspan would often talk about switches back to unpause, then we think rate hike expectations will come back to the fore. Now my colleague Charles Dumas has discussed this in much more detail in our recent LSR view, and there is a link to that below if you would like to click on it and read it. Thank you for watching, and we'll see you next week.